Hi, it's Drew Tignanelli here with Graham Ewing, our Director of Financial Planning. We both have great haircuts.
We do. No glares, so that's good too. Yep.
We got that going for us. And Graham, you're going to take us through the new Secure 2.0. They call it secure because we are going to be secure in our retirement thanks to the government.
They are. And believe it or not, they didn't make it simpler. If you can believe that. So
Simpler.
yes.
Yeah, this is simpler.
10 ways that the Secure Act 2.0 affects your retirement. So let's jump in.
Okay.
So the categories we're going to go over, seems like we're playing Jeopardy here, is the required minimum distributions, the impact there.
Yep.
The Rothification of retirement accounts.
That's pretty complicated. Right
It is. I think we made up that word too, or actually
other people
other people made up that word. And then catch-up contributions. So those are going to be the three categories.
That's all we're going to go over.
That is all we are going to go over.
There were 34 pages of reviews that we have studied on this.
And the bill,
those are just the reviews.
The bill itself, let's talk about that for just a quick second. It was part of this end-of-year spending bill, which was 4,000 pages long.
Right.
And of that 4,000 pages, 400 of them were the Secure Act. So talk about a lot of stuff that was full of stuff. So, but we're going to talk about these three categories. Jumping into required minimum distributions, starting off with a bonus round, not even into the 10 impacts yet, but there was a Secure Act 1.0. And the Secure Act 1.0 was passed in 2019. And the biggest change of that was the end of the lifetime RMD for inherited IRA, death of the stretch.
Non-spouse beneficiaries.
Non-spouse beneficiaries. And so now for a lot of people, they have 10 years to take it out. It has to be all out at the end of the 10 years. But after that rule or law came out, the IRS kind of surprised a lot of us and said, not only does it have to be all out at the end of the 10 years, but you also have to take out a little bit each year.
But only if the person who left it to you was into the required minimum distribution period of their own.
Right.
And that's the norm.
Right.
Most people die in their 70s and 80s and 90s. So that's the norm. But we do have a couple clients that died before they're required. And so they will have just 10 years. But you're right.
Yes.
And it was a surprise.
It was. So you got to look at it every single year, not just at the end of the 10 years for those situations Drew was talking about. On to number one now.
Now this is the new Secure 2.0.
2.0.
I feel pretty secure.
Talk about twos. So this was in 2022, the very end. And the biggest change here is that the required minimum distribution age changed from 72 to 73.
Now they changed it to 72 in 2019.
They changed it from 70 and a half, not 70, but 70 and a half to 72. And now for 2023, if you are age 73, that's when you would do it. So, but let's back up just a second. So an RMD, for those uninitiated, it's a required minimum distribution that you have to take out of a retirement account. As we mentioned, it used to be 70 and a half. They've changed the ages and now it's 73. But if you go all the way out to 2033, it is now age 75.
And you give the year, if you were born after 1960, 60 or later, you're 75.
Right.
For myself, born in 57, that was the largest year of baby born after World War II. It's 73. So I fall in the 73 year.
Right. And just for a fun fact, because everybody is here for all the fun, 1959, you see that little asterisk there, Drew?
Yep.
That is because in the legislative text, there was actually a technical error that made the year of 1959 say that you have it at age 73 and at age 75. There's a bit of confusion there, but the expectation is that by the time we get to 2033, we're going to have Congress fix that, but to be determined.
It just shows how much they know about what they're writing into law.
On to number two. So reduced penalty for missed RMDs. So that has changed from 50% to 25%. So if you were 73 years old and you forgot to take your RMD and the IRS caught you, they would have, before this law, charge you a 50% penalty. Now that's 25%. But here's the, the reality of it. And you want to tell them the reality of what the IRS generally does?
They rarely ever institute this penalty. So I don't even know why maybe now that they're reduced it to 25%,
right,
and if corrected to 10%, they're actually going to try to start enforcing it. I wonder if that's what they're thinking about. But I'm telling you, I've had many clients miss, and we've asked mea culpa, sorry, and they said, okay, don't worry about it. So.
But your point is a good one, is they might, maybe this is a message saying they might start forcing it.
And if they start enforcing it, remember the custodians tell the IRS what your RMD should have been, and they also tell them on the 5498 what they took out. So they will be able to do compliance on this if they want to. That'll be interesting to see what happens.
It will. So on to number 3. So if you look at this page and you see all of that small font, you are not supposed to read it. This is just a flow chart that's showing you how complicated this one is. And it is an election to treat that required minimum distribution based on a decedent's age. So you want to give everybody an overview of that?
Well, this is only for a spouse now. Right?
That's correct.
Is only for a spouse.
That's correct.
And I should let you, as Director of Financial Planning, explain this. But now a spouse can either keep it as an inherited IRA, under the former spouse's name, and her as or he as a beneficiary, roll it over to their own IRA. But now there's this new one they made where you can keep it under your late spouse's name, treat it as your own, but still under your late spouse's name.
So in an example, let's say I was 80 years old and my wife was 65 years old. Or 65. Then I might decide, all right, let me treat it. If she passed away, let me treat it there, because then I wouldn't have to start taking it yet until she would have turned 73.
It's just, I can't even get my head around this one.
Don't do this at home is the message. Number 4, no required minimum distributions for Roth 401ks. So this was a big distinction between Roth 401ks and Roth IRAs. Roth IRAs, you didn't ever have to take a required minimum distribution. For some reason, even though it's not taxable, 401ks, they made you take it out. No longer the case.
And that's why a lot of our clients who had Roth 401ks and getting up to 69 or 70, we were going to them saying, you got to roll that over to an IRA as soon as possible, because we don't want to take any chances that you hit your required minimum age and they tell us, we have to take out a Roth 401k required minimum distribution. So, very good point.
Exactly. And for all of you astute watchers here, where it says effective 2024, we put an effective age next to each one of these because they are all over the place. There will be a quiz at the end, but good luck keeping track of all of that.
If you get this all right after watching this video, well, you should go on to Jeopardy, because you have a great memory.
You do. So on to the next category, the Rothification of retirement accounts. So number 5, big change here, is that SEP IRAs and simple IRA accounts now have a Roth option. You used to only be able to do a pre-tax traditional option, but now you have a Roth option. That is actually effective this year. But if you go to any custodian and say, I want to do this today, they will laugh at you, because, again, this law was passed in late 2022. They're still figuring it out themselves.
Now, this is predominantly, Graham, for our clients that are business owners.
Yes.
But you could be an employee of a company that has a simple IRA, and now you can do it as a Roth instead of as a traditional, if you so choose. So, But then what they're trying to do is they're trying to get you to do your money after tax, and they get the tax revenue on it today. Not typical politicians, not thinking about what you're going to lose in tax revenue in the future. But, everything's about today with sometimes.
Well, and if we go a level deeper there, you have to understand how does Congress work, and they have a budget, right? Every time they make these changes, they look at a budget. And that budget is, whether they follow the budget or not is another question, but they look 10 years out. So if we think about that RMD change to 2033, that's not a coincidence. That is past the 10-year mark. And what they're worried about is, like you said, how can we get this money now? That's what Roths are.
Yep.
So number 6, employee contributions, aka matching, can be now done as a Roth. So if we look at, let's look at the detail here, right? So this is effective now. Employees actually can do the, employers can set this up now, but this is a big one. If you do this, if you make this choice, then that match will be taxable in the year you do that. So on their W-2 probably, right?
Yeah.
Right. And then the next part here is that there's different types of employer contributions. There's matching, non-elective contributions, and there's also profit sharing contributions. This does not apply to profit sharing. It does to the other two. And the last thing here is that these employer contributions that are Roth have to be non-forfeitable. What does that mean? So all of us have a vesting schedule on the matches we receive from employer. If you have not vested yet, let's say it takes 5 years to vest, then technically the way the law is written is you can't do this Roth matching option because it is not vested, it is forfeit.
Right, and you can't pay taxes on something that you could potentially lose.
Right.
And that's what they're thinking about here.
Right.
But the point to make here is that a lot of plans, small business plans, are what are called safe harbor plans. And safe harbor plans give a 4% match to anybody who puts 5% into the plan. You'll be able to go to your employer now, and because safe harbor plans are always immediate vesting, so there is no non-forfeitable portion. And then you could go to them and say, if you're going to match, I want you to do it as a Roth. There are reasons why you might want to do that. You might, the operative word there was might want to do that.
Right.
But a lot of times it's not going to be a good thing to do, because what's going to happen is it's going to bring income into your W-2 that there was no withholding on.
Right. Oh yeah.
And you could get a surprise of your life at tax time. So do it only with wise tax counsel.
Exactly. So on to the next one. Number 7 here. This is a big headline grabbing one. You've probably seen in plenty of articles. You can now move money from a 529 plan to Roth IRA to Roth IRAs. Now, I said you now can do it, but that was wrong. It actually cannot happen until 2024. And it has to be moved directly from a 529 plan to a Roth IRA. It can't be a 60-day roller. It has to go direct. And we got a lot of ands, so stay tuned here. The Roth IRA must be in the name of the beneficiary of the 529 plan. So I have 2 kids. I've got 529 plans for both of them. If I leave things as they are, I can't move that money into Roth IRA for myself. It has to be Roth IRA for them. And we're going to talk more about that in a second. But the 529 plan has to be around for 15 years. So if you're just starting this today, as you know, me as an example with my young kids, would not qualify. So that's another and. But wait,
there's more ands.
There's more ands. So the beneficiary must have compensation. So just like a normal Roth IRA or traditional IRA contribution, you have to have earned income. You have to have compensation. The next one is that this is reduced. The annual amount you're able to put in here is reduced by any other IRA or Roth contributions that you've done. So if you have a $6,500 contribution already into your Roth IRA just from cash flow or a bank account, you cannot also move $6,500 from a 529 plan. They all are
for the same beneficiary.
For the same beneficiary, right? And this one is an interesting one. So the income limits for the Roth IRA do not apply. So let's say you have a really financially successful child right out of college and they're making $300,000. They would not be able to do a normal Roth IRA contribution because they make too much money. But you don't have that limit here. You could move money from the 529 plan that they were the beneficiary for into their Roth IRA, no problem. And I think this is the last one. but it is a lifetime limit of $35,000 for the beneficiary. So that is $6,500 per year. There's $35,000 lifetime limit for that as well.
Now, this is
Let's talk about that.
this is a cool concept. It's complicated, as we've seen.
Yes.
Eight different things that you have to think about.
Yes.
It's complicated, but this could be a great concept for either grandparents, because I've had many grandparents call me up and say, I want to put some money away for my grandchildren. And I really don't want to put it into a 529 because I don't know what they're going to do for college and so forth. What should I do?
Right.
This gives them the opportunity now to do it for grandchildren. If they go to college, great, you can use it for college. But if they choose not to, the grandparent can, after they get older, move it at the rate of whatever into the grandchild's Roth IRA when they have compensation. So this could be a cool. Our high compensated clients who are younger, who have children like yourself, you could say, hey, I'm going to set up this 529 plan for my 1-2-year-old child now, knowing that 15 years from now, I could use their 529 to fund my own Roth IRA if I'm allowed to switch the beneficiary to myself at that time, which we don't know yet.
And we do not know yet. So so what Drew was saying there is you can change the beneficiary. There's options. A lot of people, like you were saying, don't want to do a 529 plan because they're worried it's going to get stuck there. Well, one of the options is, okay, if my daughter doesn't go to college, I can change the beneficiary to my son. I can also change the beneficiary to myself. And the question here is, does that restart the 15-year clock? And the initial inkling is that it actually would not, but this is so new, we really need to stay tuned and see.
It's complicated.
It is.
So far, that's all we've come up with.
It's
complicated.
It is. So the last category here, catch-up contributions. So sticking along the same theme as Roths, the catch-up contributions for anybody that has wages over 145,000 is going to be required to be Roth. So let's say you've got a 401k, and this is effective in 2024, by the way, but you have a 401k, you make more than 145,000, that catch-up contribution, which is $7,500 this year, you used to be able to choose. I want to do pre-tax and do traditional or Roth, had that option. But now that option is no longer the case. You have to do the Roth. It is based on prior year income as well. And this might, here's a potential workaround. It might not apply to self-employment income. You want to give them a reason why there?
Because the only thing I can think of is because the wording of the law is wage.
Right.
A self-employed or a partner doesn't make wages, they make a profit. And there's very different words than profit and wage. And the law says wage. So therefore, we're going to assume it's not going to apply. Now, this is the crazy one.
Right.
Because what's so significant about $145,000? I haven't figured that out.
I think Mike had a good answer, and it was that most people in Congress make what?
142.5.
So it doesn't apply to them. But here's something that's really serious. If you work at a company that doesn't have a Roth 401k, they just have the traditional side of contributions, that could create some problems, because if you have somebody that makes over 145,000 who doesn't have the Roth 401k available and they can't do that catch up, no one can do a catch up. So
And
that
now,
could create some big problems.
let's give our listeners some clarification of what. So right now, if you're under 50 years of age, you can do $22,500.
Right.
If you're over 50 years of age, you can do an additional $7,500.
Right.
If that catch-up, $7,500, is forced into Roth, you could have $7,500 of income that you didn't expect. Right. And if they don't offer it to you, everybody in the company is going to lose the option to do a $7,500 catch-up. And we're not even got to this where they're going to give us more catch-up.
Well,
and you won't be able to do that either.
And here we are. So we this is an interesting one. So if you are not 59, but you're age 60, 61, 62, or 63, not 64, but 60, 63, you have an additional catch-up contribution you're allowed to do, but it is effective not this year, not next year, 2025.
Now, keep in mind, they called this the Secure Act. So this
Right.
means that if you can do these catch-ups between 60 and 63, you
Right.
will secure your retirement absolutely beyond a shadow of a doubt, Graham.
Right.
I'm being facetious there.
I couldn't tell. So yeah, so to Drew's point, here is it in numbers. And this year, the normal catch-up is 7,500. But when this goes into effect, your option would be the greater of 10,000 or 150% of whatever the over 50 catch-up is. So 150% of 7,500 gets us around 11,000. That would be the number you're allowed to do for the 401k. Again,
And it would all have to be Roth if your wages
right.
in 2022, let's call it,
Right.
were 145,000 or more. Now, keep in mind, that's very important that you understand. It's only my wages with that employer, 145,000 or more the year before.
Right.
It's got to be Roth.
Right.
But so if I leave my employer halfway through the year,
Right.
and it's 80,000, I go to a new employer and halfway through the year, it's only 40,000. It won't be, it'll be for another year and a half until I have to
Right.
do the catch-up contribution.
And to that point exactly, there are all of these nuances to a lot of these rules. We're trying to kind of simplify it a little bit so that it makes a little bit more sense. But if you have any questions about that, this is something we definitely want to talk to you about. And the simple IRA here is similar to the way the 401k would work, just different dollar amounts. So the greater of $5,000 or 150% of whatever the age 50 catch-up is at that time.
I was just thinking, and it's kind of depressing me, is that I'm 65. So I have no chance of being secure.
No chance.
I'm already past 63, Graham, and I didn't get a chance to do this.
We're going to have to find you an advisor that can help you through that. Number 10, the last one here, is the IRA catch-up limit, that $1,000 is now indexed to inflation. It was the only one that wasn't previously indexed. The 401k was, all the catch-up contributions were indexed to inflation. The IRA is now part of that group. That is happening in increments of $100. So going forward, all of our clients will have to remember it is not $1,000, it's $1,200. And the next year it's $1,300. It's not nice $500 increments, but you can come to us for that as well. Increments of $100. And last but not least, this goes into effect next year, not this year of 2020.
You know what's irritating about this right here is that the thing that's most important to be indexed to inflation is the taxation of Social Security.
Right.
Because those laws were passed in 1982, Graham.
Right.
And here it is, 2022, 40 years later, and they've never indexed the taxation of Social Security income to inflation. That means somebody who was making $80,000 equivalents in 1982 paid no tax on their Social Security. Today, somebody who makes $80,000 is paying tax on 85% of their Social Security.
Right. Right.
Anyway, that's
So,
typical.
Yeah, it is. I can't say that we're.
But I feel
surprised.
secure.
You're secure. So the last page here of a lot of substance is that there's a lot of different times that it starts: 2023, 2024, 2025, and this is maybe half of what is really in there.
Oh, there's
So-
a lot more in there.
The bottom line is that
It's complicated.
how does this impact you? Yeah, it's complicated. If you're already a client, we really recommend you reach out to your primary advisor. We're already looking at this proactively for a lot of our clients. If you're not a client and you're interested in becoming one, suggest going to our website and you can schedule an intro and talk to us. But there's a lot of stuff here, a lot of good stuff, a lot of complicated stuff. Some things we would have liked to see different, but a lot of things that can impact you.
You know, the thing that all of our listeners who are not clients need to know is this is what a true professional financial advisor should be doing. It's understanding tax laws, comprehensive financial advice, and so forth. And so people are out there paying a lot of money to people to invest their money, and thinking they're doing a great job, et cetera, et cetera. But if you really broke it down and looked at how people invest, it's all basically done under asset allocation, some
Sure.
large caps, some small caps, some mid caps, some bonds, et
Right.
cetera, et cetera. And those things can easily be duplicated anywhere. And because of the way we operate with brokerage firms, discount brokerage firms, independent, we've cut the brokers out of the equation. We could probably do it at the same fee or less. I can't tell you that for sure, but probably can. But you know for a fact that you're going to get somebody who's analyzing all this kind of nuance that
Right.
makes a big difference
It
if you
does.
understand how to make this work for
It
you.
does. And like you said, I mean, or like we said, there was one of these in 2019. There was another one in 2022. This will not be the last one.
Hey, you
There'll
know,
be
we
more.
could go through 1,000 illustrations that, you know, like the ACA came in and they say, if your income's under this, we'll pay for your medical insurance. Well, how many
Right.
clients have we had
Right.
that have a lot of assets,
Millions,
but we
yeah.
bring their income down to what the ACA says it has to be?
Right.
And next thing you know, they're paying for their medical insurance.
It
And,
is
I
one of the
mean,
coolest things.
and that's just
Yeah.
one of all these
Right.
different nuances
Right.
that if you understand how these laws work. Anyway,
Right.
you
Right.
did a great job on that PowerPoint. I'm pretty much a PowerPoint expert.
I thought you
also.
did this PowerPoint. I'm just here talking. You did all this.
My PowerPoints are a lot more rudimentary.
I don't know. I don't know.
Anyway, you did a great job, and I hope that gives you an idea of how complicated they continue to make this. Secure Act 2.0. Do you feel secure? I don't know if they feel secure.
We're getting there. Progress. Progress is the answer.
I don't know how these politicians come up with the names of their, you know, like they called it the Inflation Reduction Act this year.
Yeah.
And I'm looking at the law and I'm saying, boy, that's a misnomer.
So Secure Act, I believe, is setting every community up for
Retirement.
some retirement, something. So,
Assurance or something like that.
yes, there is something out there. But these are the things in this PowerPoint. These are what you need.
Anyway, if you have any questions, reach out to your advisor. If you're not a client, reach out and set up an intro. Find out more about how the consulate works and what a true professional advisor should be doing according to us. And we appreciate your time. This is Drew Tignanelli saying God bless.